All right, everybody, today we're going to be talking about valuation methods. This is a pretty short slideshow. This is something that you're going to have to speak with either myself or Sylvia about when you kind of get down to the nitty gritty. The bottom line is this. I'm going to skip over to the next slide here. There's no scientific way to value these things. So basically what we try and do is put together a framework to sort of work within when it comes to the valuation stuff. Generally what we're doing is providing a quick and dirty value, something that we think is a fair market price. This is going to be very different than a valuation that will need to be performed in the event that the purchaser wants to obtain financing on a business. That's something we generally leave up to them. There are specific designations that exist, certified business valuator being one, that a person needs to actually obtain and hold for a valuation to be sticky in terms of SBA acceptance and things of that nature. So valuation in terms of this kind of course or high level overview is going to be just in reference to what our team, our brokers, our ops staff, CPAs, accountants, lawyers, whoever is working for our firm or on behalf of our firm are going to be putting together on behalf of the seller. So this is something that we're trying to put together to take to market so that when we put a prospectus out or we put a listing up on BizBuySell or wherever we're listing something, we have a fair market price established. So anyway, most businesses, it's important to know, we're going to sell for between 1.25 and 2 times their most recent year's profits. Now, the thing about this is there are sort of a lot of moving pieces here when it comes to, okay, well, what does profit actually mean? How are we defining that? So on and so forth. And I'm going to kind of skip down to the EBITDA versus SDE bullet point. So EBITDA, and I'm assuming most everyone on our team who's listening to this knows, EBITDA is earnings before interest, taxes, depreciation, and amortization, versus SDE, which is seller's discretionary earnings. EBITDA is a tricky one, especially on smaller businesses that are owner-operator. When they're owner-operator, EBITDA is generally not a true indicator of what a new purchaser will be taking home, because chances are they are not running the business absentee and they're taking some sort of salary or compensation home on a monthly, quarterly, whatever basis. Seller discretionary earnings for most businesses, and these are anything that doesn't have, let's say, free cash flow of $1 million, where it's sort of like an absentee type ownership deal. There's a leadership team in place who does not own it. SDE is what we're sort of looking at, which is going to be if the average owner-operator comes in and buys this, or the average strategic purchaser comes in and takes this over, what can they reasonably expect those discretionary earnings to be? So this is going to be some sort of combination of net profit, whatever's being reported, or EBITDA, and then any sort of discretionary income. So that can be owner salary, it can be cars, it can be cell phones, it can be travel. There's a million things that sellers often run through the business for various reasons, tax purposes, minimize take home, whatever. So at the end of the day, we're looking generally to sell this thing for between 1 and 2 times discretionary earnings. There are certain things that go into that that can sort of complicate this. So there's certain value attributes that we can sort of assign to a business to make those multiples shift upwards. Generally, the larger the business, the more likely you are to get a higher valuation. That just comes down to sort of debt service coverage and some things on the back end, which we'll talk about in some of these other online courses. But basically, we're looking at that 1 to 2 times discretionary earnings multiple. And then we're going to add in some additional sort of value items. So any inventory or fixed assets, as long as they haven't been depreciated, we'll add those back in. So it would be, let's say for the sake of argument, 2 times discretionary earnings plus assets. There's also some sort of premiums that are paid for a couple of different items. That's going to be something along the lines of recurring revenue, contracted revenue. So, our headquarters right outside DC. If we're dealing with a government contractor or another business that has long-term contracts, guaranteed revenue, for lack of a better term, there's obviously a premium that's being paid for that. The other side of the coin is, insurance agencies are a good example. True recurring revenue, not necessarily long-term contracts, fairly stable from a business perspective, again, a premium is being paid. The other big sort of notable item that can really impact the value is what concessions the seller is willing to make when it comes to deal structuring. So we have a whole nother webinar around deal structuring, but a seller who's willing to carry back, 50, 60, 75% of the overall purchase price in the form of a seller note, collateralized or not, earnout or whatever, there's a huge premium that's paid for that, because that really makes it much easier for a wider pool of buyers to come to the table. They don't need to go line up bank financing. They don't need to come up with a ton of extra cash, so on and so forth. So all of those things can certainly shift that multiple up. So generally, again, you're looking at 1.25 to 2 times discretionary earnings plus some premium adjustments for inventory, fixed asset stuff, and then any concessions the seller is making, things of that nature. Recurring revenue, again, drives a premium. Lastly, and kind of, the best thing that we can sort of advise, and what we sort of, tell new brokers, someone who's probably watching this video, run some comps. Go pull some comps. We have access to a ton of different tools that you have at your disposal now. So we have info free. We can go kind of pull and take a look at what some of these other companies' values are. You can take a look at obviously biz buy sell. You can pull reports from there and see what things are selling for. And again, at the end of the day, if you have questions, certainly come to us. But this is sort of the framework that we try and work within. We'll discuss it in some of the other webinars, depending on kind of what order you're jumping through these things in. But at the end of the day, it's important to kind of know that this framework exists for a reason. And the bottom line is, if you have a potential buyer, or a potential seller coming to the table, and they're looking for 8, 9 times, 10 times EBITDA or discretionary earnings, or whatever multiple they're working off of, or sort of a profit factor they're working off of, it's important to qualify with those sellers and let them know that that's not realistic. So that's why we kind of have this framework. Again, can't stress enough that it's not scientific, and there are absolutely exceptions to the rule. But statistically speaking, most small businesses, let's say under $1 million in sort of enterprise value, are going for 1.25 to 2 times discretionary earnings, with obviously some adjustments for some of these premiums, or premium can be created from some of these different ways. So if you guys have any questions, obviously feel free to ping me, ping Sylvia, ping whomever within the firm. We'll be happy to help you. But this is the framework that we try and work within.